It's already July, which means I'm fashionably late on our quarter one update, but just in time for a mid-year check-in. The HODL Factory has bounced back nicely after the December debacle we ended the last video with, and today we've got a lot to cover. If you're new here, I'll give a quick recap on what the HODL Factory is. And for you OGs out there, we'll be taking a more in-depth look than ever before in this one. I'll walk through the 7 companies we cut ties with, the 2 brand new holdings we added in June, and show you exactly how the portfolio is doing halfway through 2025. Oh, and one quick note before we dive in. Snowball Analytics, my favorite portfolio tracker by far and away, just launched a surprise summer sale. You can use my pinned comment to try it out for free, and if you like what you see, you'll save 30% from July 14th through the 23rd. And honestly, you're about to get a free trial just by watching, because I'll be using Snowball throughout this entire video. It's what I use to track the HODL Factory with precision, and today we're going all in. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please squash the like button, subscribe if you haven't already, and drop me a comment below with anything that comes to mind. You know what time it is. Let's grow. The HODL Factory backstory. The HODL Factory is the name for my individual stock portfolio. Basically my imaginary dividend growth ETF, which I co-manage with my longtime best friend, Hutch. We're both smart investors who stick with low-cost passively managed ETFs, but we've always had a soft spot for funds like SCHD and DGRO, especially since we both plan to retire young, ideally within the next 10 years. For years we've talked about investing, and a common theme kept coming up. I love this ETF, but I wish it did this instead of that. So finally we decided to build our own. We used Seeking Alpha screeners, added my nerdy Excel skills, and created a custom dividend growth portfolio. Hutch and I agreed from day one that we wanted to avoid emotional decision making. So we built a fairly complicated weighted scoring system that ranks each stock that passes our screener on 15 key performance indicators. And more stuff happens behind the scenes, but I won't bore you with the nitty gritty. Just know, it's all driven by a well thought out system. That said, we did build in a little flexibility recently for those rare occasions when the rules-based system doesn't make sense. And we'll get more into that later. We compare the HODL Factory to the S&P 500 because, hey, if you're going to compete with the big dogs. And don't worry, we're not tapping out of that race anytime soon. But in our actual retirement portfolios, we're really competing against and potentially replacing SCHD and DGRO. That's that dividend growth and total return machine that we like to aim for. The HODL Factory will complement things like VU, not replace them. We'll show exactly how we stack up since launching on April 20th, 2023. But before we do that, let's walk through the moves we've made this year. 2025 portfolio changes. It's been half a year since I've dropped a HODL Factory update. And if you're following along and investing in the HODL Factory, that's unacceptable timing for portfolio changes. But the good news here is that I update and share the specific HODL Factory holdings every single Friday. I've always done this and I'll continue doing it moving forward. You'll find a copy of the HODL stats in both Excel and Google Sheets, 100% free, linked in the description below. If you're tracking along, I'd recommend keeping it fun or using small dollars in something like M1 Finance. Don't throw your whole life savings in this thing yet. We didn't make any changes to our holdings in quarter one, which is wild after how brutal December was. But in quarter two, we did make some moves. We added 2 new companies, and we said goodbye to 7. And why were we smashing the sell button this quarter? I promise it was nothing dramatic. We made 2 key changes. We shrunk the portfolio from 25 holdings down to 20 to increase concentration without overdoing it. We also made a completely unrelated change to our screening process, and 5 companies no longer passed. It worked out nicely, 7 in, 2 out, a tighter focus and more meaningful exposure. All right, let's get me off the screen and open up this spreadsheet so we can walk through the specific changes. We'll start out here on the drops tab. I'm on the quarterly HODL Factory spreadsheet that I keep for Hutch and I. These are the tickers that were in the HODL Factory coming into our quarterly meeting. And we had a lot more changes than usual, and we'll get into all that. 5 of the 7 companies that we dropped in our quarter 2 meeting that we held in June were because of the new screen requirement. And we screened for 8 separate things. One of them was at least 5 years of dividend payments. We actually changed that to 5 years of dividend growth. And you can see that Hess Energy, MLI, which is industrials, SM Energy, Toll Brothers, which is home building, and Windmark Corporation, which is consumer discretionary, those 5 were dropped because they do not have 5 consecutive years of growth. And this is where Hutch and I, we've wanted to reduce the amount of companies that we've had, and I'll get into that here in a minute. We agreed that this was the perfect opportunity, knowing that 5 that we currently held didn't even make the screener, to cut from 25 to 20. And then we ultimately ended up dropping MLM as well. And that's construction materials. And that's just because it was ranked 176th on our scoring system that racks and stacks them. And anything outside the top 100, we can, at our discretion, drop. And then MSCI, which is financials, was actually a sector drop. And it might be easier for me to talk about that by just showing it. We have a sector cap of 20% for all sectors. And that used to mean you could have up to 5 companies of that sector, 5 divided by 25 total companies. Now, by dropping to 20 companies, we can only have 4 divided by 20 for the same 20% sector cap. And that's where we dropped a financial because we already had 5 of them and we had to get rid of one of them. So now we only have 4, which is 20%. And I guess I'm giving a little spoiler here of what ultimately was added this quarter. So let's just dive into our eligible tab. And this is a new one that I made. We now have a little discretion. The way we used to run the HODL Factory was exclusively from the screener. We, kind of like an SCHD or any of those type of ETFs, we racked and stacked them and we bought them. The top 25, for a while there it was almost up to 50. We'll get into that in a minute. But like, for example, this quarter, the top one was FANG, which is Diamondback Energy, and it's another oil and gas exploration. And at the time coming into this quarter, we already held 5 of these bad boys for 20%. We were heavy in energy. Now we dropped a couple with that new 5-year requirement, so we're down. You can see right here, with all the drops but not the adds yet, we had 90% of our portfolio spoken for, and we need to add 2 new companies. And here's where I say what sectors we currently have and what subsector they are, because we used to not care about this. So we had 5 companies of energy on the exact same subsector, and that's, most energies are this, but we didn't even consider subsector. And before, not that long ago, we didn't even consider sector caps either. Now we energied down and we didn't want to get another energy company. Our discretion is take the top 10 or so, and I think, we have 11 here, companies that made the screen and in order of the highest rank. So these are the ones we should buy in order. And we make sure that it's a portfolio fit. We have some KPIs here, and these aren't necessarily the scoring systems. We just threw in some categories we care about in general. This is just visual stuff pulling from the screen. This is not like racked and stacked and ranked or anything. And as we looked at Williams-Sonoma, it was consumer discretionary, which we weren't that high in, and home furnishing retail. We had home builders, but this was a new one for us. So we went ahead and swooped that up. And then Nexstar, communication broadcasting, we had none of. In fact, I don't even think we had any communication at all. Oh, and you can see down here, we didn't. So not only were these good portfolio fits, we really like the metrics just from a common sense perspective, get our yield up a little bit here, some solid net income. And, I don't need to go through all this, but the PE ratios were fairly solid value. And so we decided, you know what? That's our human interjection. Don't let this thing stack up a bunch of the same thing and stick to the system when it doesn't make sense. Grab the ones that do make sense. So lo and behold, we added Williams-Sonoma and Nexstar Media Group. And you can see they ranked very highly in our rack and stack as well. Now let's hop over quickly to the stats page. And this just gives us a snapshot. We can fill these in. This is live. So when you change the ticker, it actually changes the data. It's all live and is tied to a bunch of tables in the background. So we put in Nexstar and Williams-Sonoma. And it just, first of all, shows us our new sectors. We're below our caps. And we just looked at our subsectors. We're feeling better about that. I'd still like to energy down a little, and so would Hutch, but we're not going to knee jerk on that. So I would love to get energy to 10 or 5% instead of 15 eventually. Everything else I feel great on. I'm jumping all over the place, but our only overlap here outside of energy by subsector, we do have 2 home builders, and it was nice to get rid of one of those, Toll Brothers, that used to be higher. And then we have 2 financials, Visa and MasterCard, and I'm perfectly comfortable with 2 of the financials being them. They're both dividend growth powerhouses. But other than that, we just have one unique company, like technology, for example. We have 4 of them, but they're all unique subsectors. And so we really like our diversity better now. But getting into the stats here, and again, these are just things we care about. They're not necessarily the scoring things or the screens. Some of them are, but we just like to get an overarching view. You have a 3-year CAGR of 20.5, 5-year CAGR of 18, and we'll confirm these in Snowball here pretty soon. The yield's up to 1.35. I know I say up to. If you're new here, it used to be about 1, and we're working on increasing this slowly over time. Our net income percentage is outrageous at 30. These returns are great, but that's hindsight's 2020. Good solid PE ratio. Oh, and you know what? I hadn't updated this yet. This is the copy right before we saved the final. This should technically, we'll just put it at that. This is pulling, I just broke a formula here, but I'm not going to save it. I just want to fix this here, PE ratio. So forward and trailing 12 months is probably the one that matters anyway. Is at 24, so under the market at the time. This is a snapshot from late June. June 22nd, I think, was our meeting. And then the last tab I'll share, this just shows our current holdings by ticker and its history of when we picked it up. So this is all of our quarterly meetings here. And you can see it is once per quarter, always around the same time. We meet on the 3rd Saturday of those months, like the quarter end months. And then we queue up the changes. So the dates can vary a little, but they're always a quarter apart. And this is just showing now we're up to 5% per company. It used to be 4 because we held more. But I wanted to show a little history real quick. I know this is a long one, but I think it's important stuff. We started out with a very strict screen. You can see only 66 companies made the inaugural screen. And we held 25 of them based on a scoring system at the time that's similar to the one now. But you can see technology was 40%. And that's the only high one at that time. Then we've slowly tweaked the screen and stuff. And we would add companies. We wouldn't drop. We would just add. 0 drops. This is drops each quarter. But still very few making it. And then finally we decided, you can see clearly this was a huge move here. 25 changes. We went from 43 companies to 25. We basically redid a bunch of stuff and wanted to get down to 25. Our screen was drastically changed and our scoring system. And you can see a lot more made it at that point. But then we started to have heavy financial and technology coverage. So the next quarter, you can see it evolves a little each time. We said, you know what? Let's cap the sectors at 20. But we hadn't considered the subsectors yet. So that's where we got better here. But anyway, 149 made it. We had 9 changes. There was a lot of sector drops. They didn't do anything wrong necessarily. Maybe 1 or 2 of them didn't make the screen. In the coming quarters, it stayed pretty consistent. 1 change, 4 changes. This was my last video, I believe. 0 in quarter 1. And then 7 here. And that looks like a lot, but really that's only 2, as we've already discussed. But 206 made the screen. We opened it up even a little more, made it a little less stringent, because the rack and stacking and the scoring will still get the who's who. So what we do is we don't drop companies until they either miss the screen or they fall outside the top 100. That's why we want to get our yield up and we want to make changes, but we'll do it organically over time within sector and now subsector balance and not breaking our own rules. In other words, we're trying to save us from ourselves. We know we're emotional beings just like anyone else. It's time to see how the HODL Factory is performing halfway through 2025. 2025 year-to-date results. I'm genuinely excited to nerd out with you in Snowball Analytics. What I love most about this tracker is that there's no way to twist the story. It shows exactly what I did, exactly when I did it. No filters, no fluff. Let's get our calculators out and party. Before we dive into Snowball Analytics, I wanted to show you the spreadsheet that I update every Friday. And this is out there for free. You can always view it. This is the main tab. It's the KPI metrics. And it just shows a couple high-level things. Dividend growth we care about. Yield is nice to see. And some total return stats, 3-year, 5-year, 10-year. PE ratio, I like to see the value versus growth there. And then we have profit, like so the total returns, like we're about to see in Snowball Analytics, year to date, 1 year, and all. And we have the HODL Factory versus VU, SCHD, and DGRO. But this is out there if you're interested in seeing, and more importantly, you can see my specific holdings on the summary tab. So here's what tickers I currently have, how many shares. This doesn't matter to you, but the value probably does. You can see they're all about the same. They're 5% allocation. And then some high level stats from them, it rolls up into here, and then some of these high level stats roll over to here. As promised, we're out on Snowball Analytics, and I'm on the first page you come to is the dashboard, just a high level shot of everything. And real quick, I should mention, I just have stocks selected here. I also have my ETFs, my cash, my overall portfolio, but for this video, this is the HODL Factory, individual stocks. And then starting here on the dashboard, we have a value right now of 23,108. This might be lower than the video title. I base it on my Friday update, sort of like my main portfolio updates. And boy, has the HODL Factory struggled the last couple days. It's been tragic because we had caught up to the market. We'll get into all that. But anyway, if this doesn't match, just know that I'm recording here on Tuesday, as I always do. And we've had a couple bad days in a row. We'll get it back. But even with those drops, you can see we have a total profit of 17% overall. Not bad. Our internal rate of return, this is your annualized return like you see in Portfolio Visualizer and all the other sites, is 16%. So if you could keep up 16%, you'll be feeling and looking pretty good long term. And then again, our yield is 1.35%, which believe it or not is up, and that'll continue to rise. And here's that dividend CAGR. See, I'm not just cheating on my spreadsheets and be like, yo, guys, 20%, mic drop. And then you look and you're like, bro, it's 3%. No, it's actually 21% dividend growth. So we truly have growers here. But this is one thing I love on Snowball. Scroll down here a little bit, and we're still on the dashboard, but it'll break it down by sector. So you can hover here and you can see nothing gets over 20, slightly adjusted because I'm always DCAing in and it's balancing out in M1 finance. It buys to the target allocations, by the way. I put in 100 every week and it buys whatever's underweight. So I love that comparative dip buying by default. And one thing I love is, so you can see I have 4 industrials. And if you click on it, it goes right to the 4 companies and shows how they are weighted compared to one another. So very valuable if you're the type that likes to really dig deep and look at the details of your portfolio. I love this thing. You can see it by sector, by gain, how are those sectors doing, and then the allocation. Okay, and you'll hear other YouTubers, and Ryan Williams is one of my favorite follows, and he'll talk about this a lot, and I completely agree with them. One thing I love about Snowball Analytics versus many of the other trackers I've used, and I'm on the analytics tab here now, by the way, is that by default, they show total profit for each holding. So that does include dividends. And I love that. I show the dividend yield, the dividends received, the current value, your cost basis. So you still have that stuff you want to see, like, hey, what did I actually pay per share? But it actually gives you a total profit. And really, we can also go to portfolio holdings for the same information. There's a few different dashboards, which is why I went here. But I usually hang out on total profit because I want to see what I've made. This is where JEPQ, for example, one of my ETFs, price-wise, I'm down 6%. I bought it back in December, but my total profit is in the double digits, positive, because this actually gives you credit for your dividend. So if you're tracking your portfolios out there, I just wanted to point out, come out to this portfolio holdings, and it'll give you the real stats, unlike E-Trade, Fidelity, Schwab. I've used them all. From this snapshot, usually, quote unquote, total return on those will just be price return, as many people know. So dividend investors just love this bad boy. But now it's time from the analytics tab to pop over to dividends. We all love those. And there's that yield again. Yield on cost isn't great. We've done a lot of turnover and it's been an up and down market. So you can see that, if you've held positions for a really long time, this number gets absurdly high. there's that dividend growth. And you can see annually, you're expected to get $311 of dividends. And then over here by position, it will show the yield on cost. So for example, my cat's done pretty well. Or KLAC here, only pays 0.81, but mine's at 1.17. And again, the longer we hold these things, the more crazy the yield on cost will get. We're pretty new, so we don't have a ton going on. And then you have things like Devon Energy, which has a lower yield on cost than dividend yield. But this one, I love this one. Things with higher yield will give more of your income. So this is a passive income diversification chart. For example, Nexstar, it's only 5%. All these are about 5% of the portfolio, give or take a little, as you may have saw in the holdings. But you can see that 15% of my income comes from Nexstar. And then AGM, this one was down 10% yesterday. They fired their CFO, so don't get me ranting on this one. But you can see it's 12.1%, and EOG, a lot of times, there's Devon, a lot of the energy ones pay a little higher yield. And then you have ones that have the real low yields down here. So this just shows that income diversification, which I love. And you can see it, if you're not a chart guy, you can see it listed as well here. And then you can look at your dividend ratings. I don't put a ton into this. I do have high ratings. You can see like the dividend rating reliability, and here's my holdings. And as you can see, we have pretty stable dividends. What's our worst one? 47 with Nexstar. Oh, great, my new one. Yay. But I would say that's doing okay. And then you have your average annual growth, future payments. And I do want to show real quick the calendar, which is pretty darn accurate, I must say. You can see like in July, I have 3 dividends coming my way. Well, I had one already from PHM. And then I have one coming from Monolithic Power Systems. Actually, today, as I record this, it's the 15th of July. And then at the end of the month, EOG. So this just shows you when to expect your dividends. It's a really nice, clean calendar, and you can look at future months. It'll add it up for you. We have MasterCard, Dr. Horton, Cat, and Williams-Sonoma coming next month in August. And then the big one, September. That's that sort of traditional quarterly payment. All kinds of payments coming our way. Okay, so from analytics, we're out on the growth. And this is a really cool feature, you guys. You can have a benchmark, and you can use any ticker you want. So for example, I have VU right now, and I see a lot of red here. This was tied 2 days ago. It's so sad. But for example, let's do SCHD, a dividend growth that I invest in. And DGRO, I don't invest in it, but it's one that I could, like in a retirement type situation, and it's one of my favorites. So these are the ones in general that Hutch and I compare ourselves to. And you can see lifetime, we're doing pretty well against the dividend growth ones. We're now trailing the market, which hurts. But this is cool because it breaks it down in different ways. So on the portfolio value, what this does, it includes your contributions. The contributions are the fuchsia or pink or like the invested one. You can see there on the legend. I don't know what color that is. But you can see at any point in time how many dollars you put in and then what the total portfolio value was. It's really neat because this says if I would have put every dollar in VU instead of my portfolio, I would have $716 more dollars. If I would have put everything into SCHD, I would be down $2,200 compared to what I have now. And then the same with DGRO. I'm ahead of it by almost $800. So it's really neat because this isn't your annualized returns. That's the next one. We'll get there. This is just an account tracker, including contributions, just all things considered that happened. And this doesn't quite do me justice, but you can see where I'm hovering here. I guess we were behind VU still by $300. A midday update did have us green by like $2.11. I was so excited. This up here was green on the all. But you can see the last couple of days have not been kind. Today, the HODL Factory was down over 2%, and the market was just worse than flat. So not flattering. And of course, it's on record day. Come on now. But then if you want your just traditional portfolio returns, they have that as well. So this is portfolio performance, and let's go to all here. So you can see since inception, and this is what I update every Friday out there on the spreadsheet. As of right now, after Tuesday, we're up about 17% with the HODL Factory here compared to the VU's 21.7%. So it's smoking us now by over 4%. Ouch. And then SCHD, the purple one, is up 6.7%. So we've smoked it. And then DGRO is very solid, but we've comfortably outperformed it even after today by over 3%. And I break down different things on the spreadsheet. You can see year to date, for example. And this one, we were comfortably ahead. Come on now. But 4.88% to VU's 6.82%. and SCHD is barely positive, and DGRO is at a solid, and now beating us 5.2%. So this is just fun to track ourselves against the competition, make sure what you're doing is working. And the thing I love about Snowball Analytics, it's all linked up. Everything I do to the penny is automated. None of this is my entries, so I can't hide. All those crazy changes you saw on the spreadsheet when we switched the sector methodology and this and that and the other, it's all in here, guys. So you can see that we were dominating the market at one time. I mean, we really were comfortably by what, 10%? Yeah, over 10%. Even right here, we were starting to think, am I Warren Buffett? Am I the Oracle? And then I quickly found out, as Buffett laughed all the way to the bank, here in December, for whatever reason, I was not the next Warren Buffett. And you can see we fell behind by 3%. Before that, we had been dominating more or less since inception. I hope to continue to beat the actual competition, the dividend growth, the two lower ones here, and I want to reel in the market, or at least be competitive with. And then the next section on the growth, and I won't go through all these, but you can see here 2025, and I have the same competition, and you could just do a month by month. Like, let's just say June, the last full month. Looks like we were 4.1. The market outdid us. We crushed SCHD and we comfortably beat DGRO. SCHD seems to be taking July so far, but you can just see how they do month by month, which is pretty cool. And now this heat map right here, holdings performance is the next one as you scroll down. Growth just has so much good stuff. You can do bar charts if you prefer, and maybe that's what most people would like. And actually, let's just do bar charts. So when I look at my main portfolio, I actually like the heat map because it shows how big everything is, but you can see these are all relatively the same size. So in our case, it's probably easier visually for you guys watching to see this. And by the way, dividends are in here. You can see total profit, 61%, capital gains and dividends site-wide. Dividends are included everywhere. But you can see we only have 3 lifetime upside down ones. And of course, it's going to be energy way down here with Devon. And it was almost flat, but we've fallen behind. And then Old Dominion here. And that's like ground transportation, cargo. It's way, way down. Everything else is flat or close to and better. Hawkins, it's wild. This is one of our smaller companies, and it actually was on the chopping block. It fell outside the top 100, but as you can see, it's performed extremely well for us. KLAC, TPL used to be our big winner. We should have sold that and taken profits. Microsoft's been around forever, and you can go down the list and see them all here if you would like, but that's a Visa and MasterCard. They got off to a rough start in my portfolio, but they've brought it back a little bit, CSL, and just down the list here. And then if you come out to the metrics tab, you can see your portfolio PE, your beta versus the market, and you can see we're a little high here actually. And then the risk-adjusted returns were looking pretty good, just like my overall portfolio. Man, we're really good on this Sortino. It says okay, but I'd say, okay, if we're okay, then these are, dog poop basically. And then on this reporting tab, which is relatively new, you can get some pretty cool information by month, portfolio value, beginning, end, change, your total profit, percentage, dividends. I'll be honest, I haven't lived a lot out here because I'm a high level view guy, but you can get down and dirty if you want. And I came back out to the dashboard just for closing thoughts, but there's so many more features packed in Snowball Analytics. Those are the main things that I use and I think you'll enjoy. And I did mention it earlier, I think, but I have mine on the transactions. I have mine linked. So everything I do, I buy weekly, so you can see my buys here for the 7th. And I think mine for yesterday will be in there tomorrow. There is a little bit of a lag, but all of this is automated. And yes, I'm nerdy enough to where I've taken the time literally to side by side this stuff with M1 Finance dividends. That's under the incomes, you get dividends, all has everything, trades, buy sells to the penny accurate. But I should mention, if you're just wanting to assess your performance like I do, you'll want to turn off cash tracking. My M1 Finance can have extra cash here and there, and it can throw things off a little, the balances and stuff. So I personally disabled cash tracking. So it only does my buys and sells and dividends and stuff that matters. So it's directly apples to apples. Really, in all honesty, probably even more than Seeking Alpha, maybe. It depends on what kind of investor you are. I highly recommend this, especially if you're investing in individual stocks and you want to make sure sure that you're not a disaster compared to the ETFs over time. Good way to assess your performance without your own opinion, but with reality. Let's find out where this road is heading. Hopes and dreams. The HODL Factory is now over 2 years old, and honestly, I am still having a blast with it. Hutch and I have made some solid improvements to the system, and I really believe they'll lead to better long-term results. The dividend yield started very low and is still pretty low, but it's already started to climb. We've seen it move from about 1% to 1.35%, and we expect it to eventually land somewhere around DGRO's yield as the portfolio matures, thanks to our updated scoring tweaks. But yield alone isn't the focus. We're still targeting a strong dividend growth rate, which will remain comfortably above 10% and likely closer to 20% now and moving forward. Right now, the HODL Factory is a small slice of my total portfolio because I'm still evolving as a manager. But long term, I wouldn't be shocked at all if the HODL Factory became over 10% of the portfolio. And worst case, it crashes and burns, but I still have great wine at Hutch's place once per quarter. So either way, I win. And check out one of these 2 videos if you want to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.